Picture this. You're driving along an open road at 75 miles per hour. No traffic, the weather is gorgeous. You're heading somewhere you've been looking forward to for a long time. Life is good. But little do you know, you're rapidly approaching a four-way intersection. It'll appear without warning. No lights, no stop signs, nothing to alert you. And as fate would have it, three other cars are also driving 75 miles per hour and are headed for the exact same intersection. That's four cars, all on a collision course for a horrific reckoning. Now, this is a gruesome example and one that I wouldn't wish on my worst enemy. But joining me here today is a former hedge fund manager who says this exact situation is playing out in the markets right now. Unsuspecting investors are the drivers cruising along. They're barreling towards a major reckoning. For the first time in over 50 years, four massive, unstoppable economic forces are on a destructive collision course. And it could trigger what historians will look back and refer to as Financial Reckoning 2026. Anyone who is invested in these magnificent seven stocks, or any of these large caps for that matter, are at high risk of seeing up to 90% declines in individual positions, while the broad market could plummet 48% or more. And this former hedge fund manager you're about to meet isn't one of those pundits who has made a career out of prophesying doom and gloom. He's a 40-year veteran trader who was too busy generating profits for his clients and for himself. From 1990 to 2010, he had a historic run where he never had a single losing year for his fund. That's right. Through the long-term capital management bailout in '98, the dot-com crash, the 9/11 recession, and the 2008 financial crisis, he profited through all of it. So it comes as no surprise that his hedge fund was ranked in the top 1% worldwide by Barron's. And he has an entire chapter dedicated to him in the best-selling series Market Wizards, right next to Ray Dalio of Bridgewater Associates. Hi, everyone. I'm Kim Monning. Welcome. And seated next to me is Larry Benedict. Thanks so much for being here and taking the time to do this.
My pleasure, Kim. It's important for people to understand what's happening in the market right now.
It really isn't. There's no one better to speak about the current situation because, Larry, you have a long history of spotting the cracks and the opportunities in all types of environments. Going back to 2008, the global financial crisis was in full swing. We remember that very well. The S&P fell 37%, but your hedge fund generated 23% returns. So many other funds were closing their doors or calling clients with bad news, but you delivered $95 million in profits for your clients. More recently, in January 2022, you went on record saying, "I feel 2022 will be a tough year for the broad market, with the NASDAQ underperforming all indexes. I believe all indexes will be negative for the year." Well, the S&P 500 finished down 19% that year. And before that, in early 2020, you told CNBC that people weren't paying enough attention to COVID's impact on the market. You said, and I quote, "The second largest economy in the world is completely shut down. People aren't totally pricing that in. It seems like there's much more to come." Weeks later, the market dropped 34%. And today, once again, you see something that others are missing. So what's going on?
Well, Kim, it's no secret that AI has fueled this historic boom. When ChatGPT took the world by storm, the NASDAQ soared and returned triple-digit gains. NVIDIA became the world's first $5 trillion company thanks to its advances in AI chips. Many other tech companies like Taiwan Semiconductor and Broadcom surpassed $1 trillion in market cap for the first time ever, all thanks to this AI boom.
Yeah, it's been incredible to see, but this also has many people wondering if this is the dot-com bubble all over again. You know, I just recently saw an NBC headline saying, "A soaring stock market led by tech has some likening the AI boom to the dot-com bubble." Fortune said the comparison between today's artificial intelligence frenzy and the dot-com bubble of the late 1990s has become impossible to ignore. And Ray Dalio even confessed to the Financial Times that this AI bubble resembles the run-up to the dot-com crash. But from what I understand, you have a completely different take on this.
Yes, I've made similar comparisons, but everyone is missing the bigger picture. It's something I haven't talked about publicly, and that's why I'm here today. What's happening today isn't just a repeat of the dot-com era.
Okay, so we're not in a bubble.
Kim, I wish it were only a bubble. My latest research confirms we're on the verge of a major financial reckoning. If history is any precedent, any of the Mag 7 or popular large cap stocks could lose up to 90% of their value. The overall market could crash over 48% or even more, and that's just the beginning of the massacre.
Okay, I gotta say, if this was anyone else saying this, I'd probably say, yeah, right, come on, buddy. But Larry, you're not a perma-bear, and knowing your background and track record, I really can't dismiss this as hyperbole. In early 2022, you turned bearish on Cathie Wood's ARK Innovation Fund when it was one of the hottest performing ETFs out there. I mean, people thought you were crazy, right? But it finished the year down 67%. You were right on the money. So what do you see that people are ignoring?
Well, first off, overpriced stocks and high valuations are just scratching the surface of the dangers lurking in the financial system. For the first time in over 50 years, four market forces are on a dangerous collision course.
So 50 years ago, you're talking about the 1970s.
Well, do you remember what happened in the market then?
It was a lost decade, right?
Kim, that's right. Historians called it a collective economic malaise. It was hell on earth. If you think inflation in recent years or the job market in 2008 were bad, things were way worse back then.
Yeah, but let's go ahead and pull up some figures. I want you to take a look at this. Unemployment hit 9%. Inflation reached 14%. Gas prices quadrupled, and grocery costs soared 57%.
Well, Kim, everywhere you turned, it was pure carnage. Anyone who followed the conventional wisdom of the 60-40 portfolio actually lost 30% of their wealth in real terms. And you want to know the worst part?
What's that?
It took 20 years for investors to recoup their losses.
That's 2 decades. Wow.
Well, Kim, for perspective, after the 2008 financial crisis, it took 5 years for investors to recoup their losses. It took at least 6 years to recover from the dot-com crash and 2 years to bounce back from Black Monday.
Yeah, so a 20-year recovery, that is a red alert emergency. I mean, no wonder you're calling this financial reckoning 2026.
And Kim, my research is conclusive. It's not a matter of if anymore. These four economic forces have been in motion for years. They can't be stopped at this point. This reckoning is going to blindside a lot of folks.
I mean, most people can't afford a 20% hit to their investments, let alone 48%, right? So this would be absolutely devastating to watch a big stock holding in your portfolio crash 90%, especially for those at or nearing retirement. But Larry, I've got to push back for just a second here, because when we look back at 2008, financial firms like Lehman Brothers and Bear Stearns, they were taking high risks by having toxic assets on their balance sheets. During the dot-com bust, none of those so-called internet companies were profitable. I mean, Pets.com, that's the poster child for this, right? But today's AI companies, they're solid businesses. They have strong operations. They have track records of revenue growth and profits. They're also market leaders that dominate their industries, so competitors can't even touch them. I mean, NVIDIA has, 70% gross profit margins? Apple, of course, has always managed to turn a profit, and the iPhone continues to dominate the smartphone market. It doesn't look like that's going to change anytime soon. Microsoft reported strong earnings as its cloud business revenue soared 40%. Amazon practically powers the entire internet with AWS and its cloud business. Its profits are up 38%. And I can go on and on here, but all of these companies have the numbers to back up their success. Even non-Mag 7 companies are showing strong numbers. You mentioned Taiwan Semiconductors. Shattered earnings estimates and saw its profits surge 39%. Federal Reserve Chairman Jerome Powell sees the same thing. He says this isn't like the dot-com bubble because these companies actually have earnings.
Well, Kim, a lot of people forgot that Lehman Brothers posted record profits every year leading up to its collapse. So that's a lazy argument. Throughout market history, this pattern of high profits and earnings before a crash is definitely nothing new. In the 70s, we saw the same thing. But it didn't stop a market crash followed by a recession and all-around misery that took 20 years to recover from.
All good points. And this is all because of the four market forces set to collide. Can you elaborate on that?
Well, if you think back to recent crashes, they are triggered by a single factor, a major asset bubble in a corner of the economy.
Back in 2008, it was with housing and mortgage-backed securities. And the dot-com bubble was a result of overvalued internet stocks.
And even Black Monday back in 1987 was caused by over-leverage by portfolio insurance that led to a major sell-off on some basically small negative news in the market. But again, a single factor.
Yet the ripple effects of these crashes were felt across the market and across the economy to households. In 2008, the market crashed as much as 57%. Unemployment peaked at 10%. Companies needed government bailouts left and right to stop the bleeding. And when the dot-com bubble burst, the market lost 49% of its value. Unemployment jumped to 6.3%. Companies started going bankrupt, and investors in these companies lost pretty much everything, right? And Black Monday wiped out 33% of the stock market. Wall Street firms had to lay off 15,000 workers.
Well, Kim, that's why the situation is so dire. These examples are like one wrecking ball swinging towards a building. But right now, it's like four massive wrecking balls swinging towards the same building at the same time. And the people inside are oblivious to what's coming.
Well, to your point, Wall Street institutions have warned that a massive correction is at our doorstep. Morgan Stanley said a decline of 15% is possible. Goldman Sachs warned the losses could hit 20%, while CEO Jamie Dimon of J.P. Morgan Chase confessed he was far more worried than others about a market crash. Mark Mobius, who ran the emerging markets group at Franklin Templeton for 3 decades before starting his own hedge fund, he's calling for a 30 to 40% decline in AI stocks.
And Kim, some investors are putting their money where their mouth is. Peter Thiel's fund dumped $100 million of NVIDIA stock, its entire stake in the company, and SoftBank unloaded its entire $5.8 billion stake as well.
That's huge news. 2 of the biggest tech investors out there are getting out of the most successful AI company.
That's right, Kim. And before Warren Buffett stepped down from Berkshire Hathaway, it was holding a record $382 billion in cash. That's 3 times more cash than Amazon, Microsoft, and Apple are holding combined.
Wow, that's a lot of cash to be hoarding. Yet despite all of these bold predictions and big moves, nobody seems to be speaking about these 4 market forces colliding at once.
Well, that's why I'm here today. I'm going to show people what's really happening. Plus, I'm also going to detail the #1 off-Wall Street investment strategy that thrives in times just like this.
Thrives, even with a massive financial reckoning at our doorstep?
Yes. There's a reason my hedge fund posted outsized returns in some of the toughest markets. I'm going to pull back the curtain on that.
And it's off Wall Street, you said, so not a typical stock, bond.
Kim, it's not gold, crypto, real estate, or anything that would immediately come to mind for most people.
Okay, and this is something that the average person can take advantage of.
Absolutely. When the dust settles, some people will be counting their losses and hoping for the best, while people who follow this strategy could emerge wealthier than they've ever been before.
So I'm really excited to dive into something positive here. But first, can you take us through these 4 market forces?
Sure, Kim. I'm definitely going to cover them, but I have to set the stage here so people can understand why this situation is so dangerous.
All right, well, let's hear it.
In 1968, the market is soaring to new highs, and it's been driven by a select group of stocks, at that time called the Nifty 50. These were supposed to be no-brainer stocks. Conventional wisdom said investors could buy and hold them forever, even if valuations went through the roof.
Yeah, if I recall, this included companies like IBM, Kodak, Xerox, Polaroid, Sears, right? They were the high-tech businesses of their time. They represented the future, the new ways of doing business.
Yes, Kim, and they were solid financially. They were profitable with consistent earning growth, and they had strong competitive advantages in their respective industries. Xerox, for example, was setting earnings records nearly every quarter. Kodak was setting sales records as photography equipment became popular. It was the dominant company. And in less than 20 years, IBM rapidly grew to become one of the biggest companies in the United States.
Yeah, so they had the numbers to back up their soaring valuations.
There was no question about it.
Interesting. I mean, you can almost replace Xerox, Kodak, IBM with some Magnificent Seven stocks today. I mean, NVIDIA was just a gaming company just a few years ago, right? It was not part of the infamous FANG stocks. Today, it's among the most valuable companies in the world. I mean, it keeps posting record sales, and Microsoft recently crushed earnings estimates. Apple, too, has record sales and record profits.
Well, Kim, they say history often rhymes. These nifty 50 stocks propelled the bull market of the late 1960s and early 1970s. They were the driving force behind a lot of wealth creation.
They were, much like the Magnificent Seven is doing today. But we have hindsight as a benefit here. We know what happened next with the nifty 50, right? They crashed.
And Kim, that took a lot of people by surprise. The best of the best got wiped out. Coca-Cola fell 69%, Xerox dropped 71%, McDonald's saw its shares tumble 72%, Disney fell 87%, and Polaroid cratered 91%.
Wow, just unbelievable. And you see the same pattern playing out again with the most popular AI and tech stocks positioned to crash. Can you dive into how that might happen?
Well, Kim, this is where the four market forces come into play. Back in the 1970s, these forces collided and erased all the wealth from the nifty 50 bull market.
And the economy, as we saw earlier, was an absolute nightmare. You called it hell on earth, right? Everyday folks were struggling. So what's the first force people need to know about?
The first economic force is over-allocation in stocks.
And what do you mean?
Kim, people are talking about how overvalued AI and tech stocks are now.
Yeah, they'll point to PE ratios, price to sales ratios, and so on. Whatever the case, it's always something about stocks being more overvalued than ever, according to some measure.
You're right. But here's the thing. There's always a reason to justify overvalued stocks. Strong earnings, new technology, and various macroeconomic factors. They did the same thing in the 1970s with the Nifty 50, and they're doing it again today, saying this time is different because AI is the future and these companies have strong earnings.
You know, those might be the most dangerous words in market history. This time is different.
They certainly are. And that's why I want to share a simple, reliable way to see what's coming next. And for that, you have to forget about valuations and look at allocation. In other words, how much do investors have allocated to stocks versus all financial assets?
You mean compared to bonds, treasuries, and cash?
Exactly. Every time investors have allocated 45% or more to stocks, they were over-allocated, and the market experienced real declines in the following decade. That means your returns after inflation will be negative.
Okay, so 45% is the historical threshold for overexposure?
Yes, you can see in 1968, the 45% threshold was crossed. What followed next was a recession in 1970. That's the shaded area. Then the 1973-74 crazy bear market where stocks crashed 48%, and it took 20 years for investors to recover those losses.
Yeah, 20 years. And this is all after asset allocation hit 45%?
Yes. Historically, the threshold that warns us of negative returns in the following decade.
Well, what you just showed us certainly coincides with the start of the lost decade of the 70s.
Well, Kim, here's another example, just so you can see how accurate this indicator is. Back in the first quarter of 2000, investors had 51% allocated to stocks.
That's right around the peak of the dot-com bubble.
And what followed was another lost decade for stocks.
What about 2008? Was there overallocation in stocks then?
Well, Kim, in 2007, it reached 41%, below the 45% threshold. And the decade that followed had positive returns despite the global financial crisis.
But even getting that close to 45% allocation was enough to trigger a global financial crisis.
It is true.
Wow, well, this is all very eye-opening. So what's the overallocation in stocks that we're seeing right now?
Well, Kim, you wouldn't believe it, but we're at 53%, the highest level in history.
Wow. And that's well past the 45% threshold. Based on everything you just covered, we're in for another decade of negative returns.
But remember, this is only one of the 4 wrecking balls swinging towards us.
All right. Well, so what's the next one?
Well, Kim, the next one is a top-heavy market. For the first time in over 50 years, a large chunk of the stock market's value is concentrated in a handful of companies, the ones at the top. An already overvalued market becomes exponentially more dangerous when the biggest companies are the bubble.
I think I know where you're going with this, but can you elaborate for us?
Well, Kim, back in 2008, Lehman Brothers was a big, well-known institution. Their market cap peaked at $60 billion.
Huge. And Larry, I've heard you talk about this a lot. When Lehman collapsed, it took down the market.
And Kim, that's why the situation today is so alarming. Lehman back then was nowhere near the biggest company in the stock market. Exxon, General Electric, Microsoft, to name a few, were the biggest companies by market cap at that time. Exxon was 8 times bigger than Lehman Brothers. GE was 6 times larger, and Microsoft was 4 times larger. But these giants were not at the root of the financial crisis.
So in retrospect, this bubble that led to a global financial crisis started in a small corner of the market?
Yeah, and the same thing happened in the dot-com crash. Companies like Alta Vista, Lucent Technologies, Pets.com, and many others fueled that bubble. But they were nowhere near the size of Exxon, GE, Pfizer, and the largest companies in the market at that time. Like you said, Pets.com was the poster child for the bubble.
Yeah.
But GE had a market cap 1,600 times larger.
But that's not the case today.
Right. Everything now is top-heavy. Too much wealth is concentrated at the top in the Magnificent Seven.
So what you're saying is that past crashes were, I don't know, like an aircraft carrier losing a plane or two. Not a great situation, but at least the aircraft carrier is still in one piece. It's operational. But the situation developing today is like the entire aircraft carrier going under and taking everything with it.
Kim, that's a great analogy. This is exactly what happened in the late 1960s and early 1970s. The Nifty 50 drove the stock market higher and higher. These were 50 large-cap stocks. And the 5 largest Nifty 50 stocks, IBM, AT&T, Kodak, Xerox, and General Motors, made up 25% of the S&P 500 at that time.
Think about that, 25% in just a handful of stocks. And that's a lot of eggs riding in one basket, right? I know the figure today is pretty high. So what are we looking at?
Well, Kim, today the Mag 7 are the dominant companies. Together, they make up 35% of the value of the S&P 500.
That's a whole lot of wealth concentrated in just a few companies.
But listen to this. The 10 biggest stocks made up 40% of the market value. And the top 20 stocks make up 50% of the market value.
So these past few years, just a handful of companies have been driving the market's performance.
Well, Kim, it's the most top-heavy market in history. The last time it was even close to this level was in the late 1960s. You can see how top-heavy it was here.
Yeah, this was the precursor to the 70s bear market. Investors got crushed.
Well, from 1973 to 1974, the market declined 48%, the biggest drop at the time since the Great Depression. Popular Nifty 50 stocks crashed, as I explained earlier. Some lost 80 to 90% of their value. All the gains of these stocks from the bull market leading up to 1973 were wiped out. From 1973 to 1977, these stocks were negative.
So right now, investors are overallocated with 53% in stocks. 50% of the market's value is in just 20 stocks, which shows the market is extremely top-heavy, and it gets even worse.
Kim, unfortunately, that brings me to the third economic force, a dollar reset. Recently, the value of the dollar has dropped by 10%, the lowest level since the 1970s, and Morgan Stanley expects it to drop another 10% in the coming months.
So what's causing this decline?
Well, Kim, this is a complex topic. but I can simplify it to one simple explanation. When a country is faced with growing debt, politicians have two choices. They can either raise taxes and cut spending or make the debt a lot cheaper.
Well, from where I'm sitting, it doesn't matter what side of the aisle you fall on. We know that raising taxes and cutting entitlements is political suicide, right? No politician who wants to get reelected would ever choose that option. So that leaves only one option on the table. What does making the debt cheaper entail?
Well, Kim, let's say you borrow money to buy a house for $500,000. If the currency weakens by 50%, that same house would now cost you $1 million.
So I can pay back $500,000 and it wouldn't even buy the same house anymore?
Right. Devaluation is a money reset. Houses didn't get more expensive. Your dollars don't stretch as far as they used to, but it helps the party in debt because they can pay it back in the weaker dollar terms.
You know, I read something about this. Ray Dalio even said that devaluation is the preferred path of government policymakers and to bet on it happening.
Well, Kim, he's referring to history. It happened back in the 1970s when Richard Nixon was the president and ended the gold standard. The dollar was becoming too strong. American goods started to become more expensive abroad. For the first time in the 19th century, the U.S. saw a trade deficit as cheap imports from overseas flooded into the United States. Plus, the debt and deficit started piling up with the Vietnam War in full swing.
The U.S. was essentially running out of money. All these dollars were in circulation, but there wasn't enough gold to back it. Nixon didn't want to face a situation where a major bank or foreign government asked to exchange its dollars for gold, and we couldn't provide it.
Yes, so he ended the gold standard on August 15, 1971. The U.S. dollar was no longer convertible to gold at a fixed rate. And from 1970 to 1980, the value of the dollar dropped by over 30%.
That is rough. Investments were crashing and people were losing purchasing power on top of that. This is happening again today?
Kim, the U.S. has to devalue right now. They have no other choice. The recent national debt is $38 trillion. The debt to GDP ratio is sitting at 125% right now. It's the highest level in history.
You know, I recently saw that $1 trillion alone is just going towards interest. That's double what we were paying 5 years ago. And it's actually more than the budget of the entire United States military. That's funding for all branches.
That's the scariest part. In the last 200 years, 51 out of 52 countries that reached 130% debt to GDP ratio had defaulted. And the Congressional Budget Office warned that the United States could hit that threshold soon if nothing gets done.
So it sounds like the debt needs to be made cheaper immediately.
Well, Kim, when you look at it from this lens, all of Trump's policies begin to make sense. The attacks on the Fed, the constant tariff announcements, threats against NATO allies to pay their fair share of defense, even the push towards crypto and stablecoins, these are all policies designed to weaken the U.S. dollar.
Trump's famous Mar-a-Lago Accord, authored by his top economic advisors, has said that a strong dollar is responsible for the American dream being out of reach.
Yes, Treasury Secretary Scott Bessent even told his hedge fund clients that weakening the dollar early in his second administration would make U.S. manufacturing competitive and that a weak dollar and plentiful cheap energy could power a boom. And the president himself even said he prefers a weaker dollar.
So point blank, they want a weaker dollar.
Yes, that's why the dollar is down 10% already, the most since the 1970s, and it's expected to tumble even more. Anyone invested in U.S. treasuries or bonds is going to see real declines just like back then. Foreign central banks have already been dumping dollar assets. They now own more gold than treasuries.
Gold, in a way, is becoming the new reserve currency. And if I recall, the 70s were a bull market for gold, just like we've seen in recent years.
Well, Kim, it's just a signal that we're in the middle of the dollar reset, and most folks are definitely not looking at this.
This is crazy. People are losing on all fronts here if all of this unfolds. Stocks go down, the dollars they hold become more worthless, and there's no way to preserve purchasing power in traditional safe assets.
Yes, and it gets worse when you hear the fourth and final force that's barreling towards us. It's the one that's going to hit people the hardest, and virtually guarantees any recovery will be a long, hard road.
All right, Larry, before we dive in, I just want to recap for everyone. Market force, number one, is a historic overallocation in stocks. Anytime investors had 45% or more allocated to stocks, the market experienced a lost decade immediately after. It happened in the 70s, and it happened during the dot-com bubble. Right now, investors have 53% allocated to stocks, the highest level in history. That signals that another lost decade is at our doorstep.
Yes, Kim, that's a good summary of the first force.
Right. And force number two is a top-heavy market. The biggest companies are the bubble. The largest 20 stocks make up 50% of the market's value. The Mag 7 alone accounts for 35% of all the stock market's value. The last time we saw anything close to this was in the 1970s. Today's top-heavy concentration means a crash would be more devastating than what we saw in the 2008 crash or the dot-com bubble bursting.
Unfortunately, Kim.
Yeah, and then the third force is a dollar reset. America's debt load has become too big, so we have to make the debt cheaper through devaluation. That explains all the attacks on the Federal Reserve, the tariff announcements, trade deals with countries, and even things like stable coins or making the U.S. the crypto capital of the world.
Yeah, they've all put downward pressure on the dollar, which is why it's trading at its lowest level in over 50 years.
And this will hit anyone who is invested in low-risk assets like U.S. Treasuries and other bonds.
Well, Kim, that's what happened in the 70s. Bond investors got crushed. Investors lost 60% of their purchasing power on their long-term bonds. In other words, $1 million nest egg in these assets became equivalent to only $400,000.
Ouch. I mean, that is devastating. And we haven't even talked about the worst part yet. But, Larry, this environment, this is the type where you excel. So there is some good news coming. There's a great opportunity for you. But let's go ahead and hear it. What is the fourth economic force?
Sure, Kim. The fourth economic force is an affordability crisis. I'm sure you've heard about this.
I have, yes. And politicians are campaigning on it. The Wall Street Journal, Fox Business, and other media outlets have talked about it nonstop. The Wall Street Journal even said it can't be solved.
Well, Kim, some of our viewers, if not everyone, might already be feeling the impact of higher prices from things like healthcare, housing, and groceries. Others feel like it doesn't apply to them. Maybe they're empty nesters, they have a job that covers health insurance, or their mortgage is paid off.
Larry, I don't want to sound snobby here or presumptuous, but, many of our viewers, let's just say they're doing pretty well. Sure, higher costs are definitely a real disappointment, but they're not going to exactly break the bank for a lot of people.
I know exactly what you're talking about. I have many colleagues and former clients like this. But these people are the ones most likely to end up in a world of hurt. Their years of hard work, saving, investing go up in smoke if they're not careful, because an affordability crisis threatens the very engine of the American economy.
The engine of the American economy? That sounds intense.
Well, Kim, think about it. 70% of America's economy is driven by spending. When everyone is upgrading their phones and devices, traveling, and buying big-ticket items with loans, the economy is running hot. This is when companies beat earnings expectations and need to hire more workers to keep up with the booming demand.
And that fuels competition for workers, which leads to higher wages and even more spending.
Exactly. You get it. Economists call this the virtuous cycle of growth. But the opposite can happen. The middle class is spending more and more on housing, healthcare, and other necessities. It eats into discretionary spending.
Okay, and that's when people tend to hold on to their old iPhone models a little longer. Maybe they cancel their travel plans and delay that home renovation.
Yes, Kim, it also eventually leads to an increase in defaults for existing loans, so the financial sector begins to crack. Lenders go into defensive mode, and economic activity grinds to a halt. Then businesses see their profits take a hit. Mass layoffs happen, and that hurts spending even more. It becomes a vicious cycle that's hard to escape. Right now, the affordability crisis is the biggest that we've seen since the 1970s.
Back then, stagflation dragged the economy and markets down. High inflation, high unemployment, and low growth, not to mention a bear market where the market crashed 48% and the biggest stocks collapsed 80 to 90%. But the economy was handcuffed in a way. High inflation triggered the affordability crisis, and high unemployment dragged consumer spending down. There really was no way to address the low growth.
Like I said, it becomes a vicious cycle that's hard to escape. Nixon even tried to implement wage and price controls to tackle high prices to relieve the affordability crisis in the 70s.
Arguably, that only made things worse.
The truth is, there's very little that can be done from a policy standpoint to fix these things. People have to just endure a lot of pain until the economy recalibrates. That's why we saw a lost decade back then.
Well, that certainly explains a lot of what's happening right now. We're starting to see the early stages of this doom loop. Here in my notes, we're going to pull those up on screen for you. I see that car repossessions have hit Great Recession levels. Student loan delinquencies are also surging. 34% of borrowers had payments at least 30 days late. That's a record number. And credit card balances are up to $24 billion, with the number of accounts 90 days past due at financial crash levels of 7.1%. This is dire.
And it's no coincidence that the largest companies are announcing layoffs. Amazon eliminated 14,000 jobs. Verizon let go 15,000 people. UPS cut 48,000 workers. Last year, employers cut more than 1.1 million jobs, the most since the pandemic when the economy was shut down.
All of those job losses in the midst of an AI boom. I mean, think about that. Something doesn't add up. And you've pinpointed it. 4 market forces that are creating the perfect storm for a financial reckoning. Larry, many people, including myself, they're wondering, what will be the straw that breaks the camel's back?
Well, Kim, you talked about the strength in the Magnificent Seven's earnings earlier.
Right.
Well, they can't go on forever, and there's a simple reason for it.
What's that?
Well, Kim, you see, these companies succeeded by being asset-light businesses. They sold software, tech platforms. In other words, they had high margins and low capital requirements.
That's why tech has been so profitable. It can rapidly scale with minimal extra capital invested.
Well, Kim, but now these firms have been fueling the largest capital expenditure boom in history, surpassing the railroad expansion of the late 1800s and the telecom build-out of the late 90s. That's a fatal mistake.
You're talking about the AI build-out with data centers, semiconductor fabrication plants, as well as power and cooling solutions. I mean, that all seems necessary. It's an investment in the future. How is that a fatal mistake?
Well, these AI firms are planning to spend $5 trillion over the next 5 years. They spent $400 billion last year alone.
I mean, we're seeing an AI arms race, one that we want to win. No company wants to lose out, so they're all plowing more and more money into everything.
Right, and that's the problem. With all this new capital investment, these companies are all transforming into asset-heavy companies.
They're going to be saddled with costs to maintain and upgrade all this infrastructure going forward.
Right. Historically, since 1963, any company that became an asset-heavy company underperformed the market. The companies that built out the railroad infrastructure lagged, and companies that built out the infrastructure for the internet did as well.
So AI investment is supposed to be the thing propelling these companies into the future, but it could be the thing that leads to their downfall?
Yes, they're essentially abandoning the very business models that made them successful. The math isn't on their side either. To justify the $5.2 trillion in spending, these companies need to generate $2 trillion in AI revenue by 2030. Their current AI revenue is $20 billion.
Whoa, so they need a 100-fold increase in less than 4 years to even break even?
Yes, and MIT recently did a study and found that 95% of organizations have gotten no return on their AI investments so far.
So they're a long way off.
Well, Kim, it gets worse. Some of these firms are engaging in what analysts are calling circular financing. Let's say NVIDIA invests $100 billion in OpenAI. OpenAI needs to buy some advanced AI chips to grow. Guess who they're buying them from?
NVIDIA. Okay, so let me see if I got this right. NVIDIA is basically buying their own products through a middleman?
Yes. Now, don't get me wrong. I do believe AI is going to be transformative. It's going to revolutionize society, but people often make the mistake of confusing the potential of a technology with the potential of an investment. Once you look under the hood of the current boom, it's a lot like smoke and mirrors.
Doesn't inspire a lot of confidence in me that OpenAI is asking for federal loan guarantees either.
Well, Kim, imagine what's going to happen when Wall Street realizes all that AI capital investment won't deliver the promised returns.
The Mag 7, the ones making the biggest capital expenditure bets, will get sold off and fall.
And in a top-heavy market, that's the entire market going down. A similar situation played out in the 1970s. The stocks that were setting up records a few short years before were bleeding out with no end in sight. Slower earnings and bad economic news hit them very hard, and these stocks were in the dumps for a really long time. And there was no spending to rescue these businesses because people were dealing with an affordability crisis. As a result, nobody was hiring. It was a vicious cycle that was hard to break out of.
So hard. Larry, I just want to change gears a bit here. What do you think the average person watching this can do to protect and maybe even grow their wealth in the face of this financial reckoning?
Well, Kim, that's a really great question, and I'm glad we're getting to this part. I am no longer running my hedge fund, so I can talk about my best strategies publicly. And I want to tell you right away that I'm not going to be sitting on the sidelines amidst this reckoning.
Wait, so even though you know a financial reckoning is pounding at our door, you're still going to be trading?
Yes, and it's really the best time for us. This crisis is no different than the other ones that I've profited from for years. In fact, people have the opportunity not to only skirt this disaster, but to emerge much richer.
Well, I like the sound of that.
Well, Kim, it all boils down to one rule that I follow religiously, especially in times of turmoil. The rule is the reason behind my success as a hedge fund manager, and it's why I've been able to profit even in the worst market condition. But it flies in the face of conventional wisdom. And here it is. Trade it. Don't own it.
Okay, I think I know what you're getting at, but why don't you just explain it to be sure?
Well, if you have a portfolio, you own shares of a company. Sure, some go into the red, and maybe a few deliver big returns like 100% or even 1,000% or more.
That's over a few years usually, unless you catch lightning in a bottle. Then you can make those gains in 8 to 12 months. And that's why people have portfolios of stocks. It spreads risk around and increases the chances of hitting a big winner.
Yeah, Kim, but I'm ignoring all of that and targeting 10%, 50%, or even 100% profits in a matter of days by going off Wall Street and not owning any stocks.
Okay, I knew it. You're trading options.
Kim, options are the best money-making strategy when things get volatile.
They certainly have a lot of benefits, that's for sure. First thing that comes to mind is that you have a limited downside, but also an unlimited upside.
You sure do. If you have $10,000 to invest and you want to buy a stock, you have to use all the money to buy as many shares as you can own for the $10,000.
Yeah, could pay off a few years down the road, but you risk losing it all.
Right. Just to be clear, all investing carries risk, and you should never invest more than you're willing to lose. I know our viewers are probably smart enough to understand that.
Yes, I know they are. And that's the beauty of options. With $10,000, you might only need to front 1 or 2% of that to get in on an options trade. And you can also multiply any profits.
Yeah, Kim, I call that the multiplier effect. I actually have many examples of that from 2021 when the markets experienced volatility and headwinds. For example, on November 1st, 2021, I recommended an option trade to a select group of my readers. In 1 month, the actual underlying stock went up 18%.
That's a good find.
But get this, the option delivered 300% in just 4 days.
Okay, I think anyone out there would take 300% in 4 days over 18% in a month anytime.
Well, that's the power of the multiplier effect.
And you can also make money when the stock goes down in value.
Sure, in early 2022, one stock I was monitoring fell 5% in just 9 days. That's usually something you want to stay far away from. But the option trade generated a 120% return in the same time frame.
That's amazing. Down or up, it doesn't matter. A small move in either direction could translate into 5x, 10x, or even 20x returns in a matter of days.
Well, Kim, that's why I say trade it, don't own it. When things turn south in the market, people either sell and take the losses or they hold on for dear life, hoping things will bounce back.
And I've got to say, hope has never been a great investment strategy.
That's why it's so important to trade the reality of what's happening in the markets right now.
And that's what the most successful investors do. They acknowledge reality, they take decisive action, and I imagine a lot of our viewers can benefit from that approach in the coming weeks and months. And that brings up a question I have. I'm not sure if you'd be willing to reveal it on the air, considering there are millions of people set to view this.
Well, Kim, what do you want to ask?
Okay, well, with options, you can buy calls. That allows you to profit if the underlying asset goes up in price, or you can buy puts where you profit if the underlying asset goes down in price. And you just showed some winning trades of yours. So I got to ask, how do you know which way things will go?
Great question, and I'm glad you asked it. This is the million-dollar question in options trading, and my strategy is acting on mean reversals.
That sounds like some kind of signal.
You nailed it. I'm not worried about deciphering a company's financials or analyze its potential market size or whether an AI data center investment will pan out. In fact, I'm not even worried about whether we're heading for a bull or bear market.
You know, that makes a lot of sense. You ignore the noise and just focus on what's in front of you.
Yes, I'm focusing on how a security is trading in the moment, and that's the only thing that matters. If you take any stock or ETF, people are buying or selling them all the time throughout any given trading day. That's normal activity, but when I'm trading, I'm looking for abnormal activity.
You mean like when something's being overbought or oversold?
Exactly. When the price goes too far in one direction, a mean reversion is bound to happen. And you can trade these moments to capture 50% or even 100% profits or more in a matter of days.
That sounds really nice. So if something is overbought, the prices will spike, but they'll eventually come back down. Or if something is oversold, prices will plummet, but they'll bounce back.
Well, Kim, it's almost a law of physics, like a rubber band being stretched. If you let it go, it'll snap back to its original size and shape. Let me show you an example with GLD, the gold ETF. You can see from May 14, 2025, GLD was trending up towards $320, but then it was overbought relative to the trend. People were eager to get in.
Yeah, I can see that in the chart there. It looks like it snapped right back, though.
And anyone could have placed a simple trade to bank 156% from a move when it bounced back just 6 days later. Same idea here. GLD was trending up, but then it became oversold on April 7, 2025. It snapped back in just 2 days, and anyone could have placed a single trade to pocket 143% profit.
And Larry, you see lots of opportunities like this on the horizon?
Yes, with a lost decade, you'll have lots of panic, but there are also going to be glimmers of hope mixed in. Again, I'm not worried about any of that. I'm going to be laser focused on identifying a handful of tickers and waiting for mean reversion signals. These tickers see a lot of action daily. They're going to be overbought and oversold a lot in the next 10 years, and my trading system will alert me when that happens. I have their charts up right now on my trading station, and my system will alert me whenever a mean reversion happens.
And do you mind sharing what these tickers are?
Kim, I was planning on doing something even better. I just compiled a report that details these tickers. It's called the Lost Decade Playbook.
And if I recall, back in 2022, you predicted the markets were due for a correction. Your prediction was right on the money, yet again. The S&P 500 ended the year down 19%, but you went public with this service halfway through the year and recommended plays on just 3 tickers. The result was a 100% win rate. So anyone who followed your research and recommendations had a chance to grow their wealth.
Yes, I did a presentation just like this one where I showed folks exactly how to trade that year. Millions of people viewed that presentation, but unfortunately, only a small percentage of people took action.
And you know what? That's pretty typical. People tune in, they get distracted, maybe with a text message, or they're trying to multitask, and they end up procrastinating.
But Kim, this situation is dire. A major financial reckoning is at our doorstep. That's why I'm doing my part to make sure nobody misses the research that could be critical to their financial future. The Lost Decade Playbook. The report is valued at $99, but it's available for free for anyone that is watching this today.
Yeah, and we're going to set up the link for people to access that report here in just a moment. But what about people who've never followed option strategies before?
Great question, Kim. Many people believe option trading is too complicated. They don't even want to get started. But I don't want anything holding people back today. I'm giving away another report called Larry's Guide to Options.
And this is the same one that I've seen valued at $99?
Yes, and it's also free for our viewers watching this right now. It also comes with a video training series so folks can actually see how it works with demonstrations.
Well, I can imagine a better resource for anyone looking to get started with options or, even if they're just curious about it. With your track record and experience, there's really no one better to learn from. People with access to this guide got comfortable and started making money right away. Let me just read a few endorsements from your readers. Charles T. said, "Hi, Larry. I started using your services as a way to turbocharge my retirement. And I'm happy to say I'm up close to $40,000 in just 2 months. Me and my family want to thank you personally." Lou S. said, "You teach trading in such simple terms that a newbie like me is getting it." Carolyn C. wrote, "I am 84 years old and just did my first ever options trade. Well over a 100% gain. Thank you for getting me a new life in a new world." Oh, that is incredible. It's pretty cool to see complete beginners transforming into seasoned traders with your guidance.
Well, Kim, this is my life's work. Trading has been very good to me and my family. During those big market crashes and recessions, I saw my colleagues and friends worry about their finances and whether they had enough to retire. But my mantra of trade it and don't own it got me through all of those rough times. And I want to share it with everyone today.
We love it. More than got you through, though, right? During the 2008 financial crisis, your hedge fund returned 23%. You generated $95 million in profits for your clients.
And since I am no longer managing my hedge fund, I can share my best ideas. And there's never been a better time to start.
So you believe with these resources, people can get started trading options from the very beginning, even in these turbulent times?
Yes. With my Guide to Options report, I start from the most basic level.
So you cover how to create an account, what all the terms like expiration and strike price mean, how to buy and sell your first options using your specific method with mean reversion. All of this?
Yes, I also detail my top tickers, and these reports are free for anyone who tries out my research service, One Ticker Trader.
This is the service that allows everyday people to tap into the power of your trading system.
Yes, back when I was running my hedge fund, I took my ideas and set up a system to make money for my clients. With One Ticker Trader, I do the same thing. Only I share it with my members in a way that is easy to follow and act on if you decide so. So whether you have $1,000 to invest, $10,000, or even $100,000 or more, you can start following my best trades.
And these reports, they give away your secret sauce. And people could theoretically take that and set up a system so that they can get alerted anytime an opportunity arises. Or they can simply join One Ticker Trader, where you take care of everything for them with trade alerts and updates.
This service makes everything so easy. People are really loving it. Check out what a member recently wrote me.
Yeah, let me read that to you. Finally, a signal service that delivers profitable results. I've tried many signal services and even live trading rooms, and none of them have delivered the kind of results that you have with your One Ticker Trader service. It's good to know there is at least one honest guru out there whose reputation is well earned. Thank you. And that's from Jason VE. It sounds like you are doing a great job, Larry.
Well, I can't take all the credit. I have a team working with me behind the scenes. We all work hard to make sure people get the best experience possible.
And there's a lot of benefits that come with One Ticker Trader. First and foremost, anytime a new trade opportunity comes up or when it comes time to sell a position, your members will get alerted right away. You also do a fireside chat once a week called Ask Larry Anything. You provide your analysis and commentary on any market news. Sometimes you talk about things the mainstream media should be covering but aren't. And then you go through the mailbag and answer any questions current readers might have. It could be about AI infrastructure spending, past trades, crypto, Fed policies, you name it.
The only thing I don't do is provide personalized investment advice, but anything else is on the table.
All right. And new members who have questions now can send them in?
Yes, right from the moment they sign up. And they also get to see my entire model portfolio of trades. There may be some open positions people can still get in on. It's all updated on my members-only website.
Now, I got to tell you, I'm always a little bit skeptical of people talking about win rates. Sometimes they're hypothetical and back-tested on historical trades. But is it true you have a 79% win rate?
Yes. And as I post more successful trade recommendations, I can use the data to tweak and tighten my system's parameters for even better performance. Even after 40 years of trading, I'm always looking for ways to improve. It's my passion, and I'm lucky to get to share it with people through One Ticker Trader.
And you know, Larry, that really shows. People who followed your trades have certainly reaped the rewards. I have an email here from Christopher K., who wrote, I entered my first trade last week using your One Ticker Trader and made a profit of 23% in just 2 days. Thanks for helping the common folks. Frank Yu is certainly happy. He set another great trade, 65.9% in 7 days. And Larry L. is crushing it. He said, in the past 11 weeks, I have made 11 trades with an average profit of 32.4%. Larry, I believe you are the real deal. You really are.
Oh, thanks so much, Kim. I love getting these types of messages. This is why I do what I do.
Yeah, well, let's unpack this last one here just a bit. 11 trades at an average of 32.4%. If he put down $5,000 on each of them, that's nearly an extra $20,000 in the bank in less than 3 months. Now, imagine if you're making these kinds of profits when the overall market is down, when the Mag 7 stocks aren't producing, when bonds are losing money. Your research has confirmed this is all happening, but by trading it, not owning it, as you've said, folks have a chance to walk away richer. They have the chance to secure their retirements.
Well, speaking of which, I almost forgot. I have another report, the 3X Retirement Accelerator. It covers a unique strategy that makes money when the markets begin to decline.
That sounds pretty useful in a bear market.
It's a great time to look into this. It's valued at $199, but I'm including it for free for anyone who joins One Ticker Trader today. And I also want to give away another report, The Great Wealth Shift. When AI stocks fall, the S&P 500 will rebalance, and a new wave of companies will lead the index. I have a strategy to make trades and profit from the overall trend of rebalancing. That's why people have a chance at 50% or even 100% gains in a matter of days. And I have one ticker I've zeroed in to do that.
You're giving away a whole lot here.
I want people to be prepared for what's coming, and that's why I've compiled all these reports.
Now, from what I understand, you also wanted to authorize a special price to get people started today.
Yes, Kim, just $19 for a full year's access.
That's an amazing deal. Last time I checked, a full year to one ticker trader went for $499. So people are getting over 90% off the regular price. All right, and it looks like the link is ready to go, so go ahead and click the button below to get started. You'll be taken to a secure order page where you can review everything you're getting today, and it's a whole lot, so here's a quick recap. When you join One Ticker Trader today, you'll get real-time trade alerts straight to your inbox. Whenever Larry's system gets the signal for a new trade or says to exit an existing one, you'll know about it right away. Access to the members-only website. You'll see the model portfolio, any special reports, all the issues and updates, and much more. Access to Ask Larry Anything. These are the weekly fireside chats where Larry will talk about market trends and then answer reader questions. All of this on top of the special reports Larry has prepared for you. The Lost Decade Playbook, a $99 value, yours free. Larry's Guide to Options, also a $99 value, yours free. The 3X Retirement Accelerator, a $199 value, yours free. The Great Wealth Shift, another $199 value, yours free. Plus a 96% discount on a year membership to One Ticker Trader. So that's $1,095 in value for just $19. Am I missing anything, Larry?
Everything is backed by my 100% satisfaction guarantee.
That's right. That means people have a full 30 days to check out the model portfolio, read those special reports, and follow the recommendations. But if at any time in the next 30 days you're not happy for any reason, you can just contact Larry's support team for a full refund on your subscription. Is that right?
That's it, Kim. And you can keep all the special reports as a gift. Just my way of saying thanks for giving my trading research service a try and putting your trust in me.
Well, that's as fair as it gets right there. And not to mention, people are getting a chance to see how a real professional navigates these markets. You know, it's not every day that someone can get trade ideas from someone whose hedge fund was ranked in the top 1% worldwide, someone with 40-plus years of trading experience at the highest levels, someone who made money during the worst market conditions, and someone who has helped countless everyday people see hope. So, we still have some time left here. Let me just read some of the letters your team sent me from some of your members. Mike S. wrote, I've been able to book an average gain of 19.98% on 4 trades in an average holding time of 3.75 days. That's a solid return in this market environment. He also wrote, I just want to express my appreciation for your One Ticker Trader. It's a huge help to me and my family right now when almost everything else in my portfolio is in the red. Thanks so much for the difference you are making for me and my family. Larry, you have quite the track record, and you've helped countless people.
Well, Kim, this is what I do now. I'm at the stage in my career where I'm looking to give back, and all these messages are keeping me going.
Oh, I'm sure they do. That is so amazing. All right, well, I think we are coming up on our time here, so let me just give some final thoughts. You heard it here. Financial reckoning 2026 is upon us. When the 4 market forces finally collide, it'll trigger a reckoning bigger than the dot-com bust and more devastating than the 2008 financial crisis. It'll be the miserable 1970s all over again. A bear market followed by a lost decade as the affordability crisis slows spending and brings business activity and profits to a standstill. But the solution isn't to sit on the sidelines. You want to trade it, not own it, as Larry said. That's how you can make money no matter which way the market moves, and you don't have to bet the farm to do this. The very nature of the type of options Larry recommends allows you to have limited downside and unlimited upside. Profits of 100% or more in a matter of days are possible, and Larry has provided all the resources to get you started, including the best ticker symbols to trade, the best strategy, and the best system. Now, if you're not convinced at this point, I'm afraid there's nothing more I can say or do. But the fact that you made it this far shows me you're a different kind of person. You know something feels off in this economy, and you not only want to know what it is, you want to take action to make sure you and your family end up in a better place. Am I right? That's the opportunity in front of you right now. Just click the button below to get started. Again, I'm Kim Monning. Thank you so much for tuning in. And of course, Larry, I've got to thank you for sharing your insight and guidance as we face this financial reckoning.
Oh, thanks so much for having me, Kim. I really appreciate it. And I'm looking forward to working with anyone who joins the One Ticker Trader today. Let me help you put a P on the page.